So what to watch? There's 5 things we're watching. Inflation. We're going to talk about this from a different perspective. Why inflation is important from a business perspective. Why is it important to us? What we are is we are retirement income planners. That's what we do. Like that's what we'll call ourselves. We look at retirement income. What that means is we try to create an income stream that somebody can't outlive, starting from when they retire, for 30 plus or minus years. So 2.5% a year is no big deal. 2.5%, 3% in a 30-year period is an enormous undertaking. Call it an $80,000 income that you have the first year you retire from a portfolio has to be $160,000 or $240,000 the last year to buy the exact same basket of goods. That is a huge planning problem, right? Is everyone, I see tons of nodding heads, okay. So this is what we see. This is what everyone's talking about right now. What we always think about is inflation. So the Fed sees 1.5%. A basket of economists see 2%. Everyone else, regardless of income, regardless of age, sees 3%. Explain the difference. Why do you think that difference exists? I think it's this. When we shop, the stuff that we buy that remind us of price are the things we buy a lot. Food is definitely up in price, no question. But the Fed and the economists are looking at the basket of things that we buy. And gas moves really quickly. Rent doesn't move as quickly. It moves, but doesn't move as quickly. Medical care moves, but it's also moved down recently, right? So the things that we buy are the things that we see going up every single week, every single month. I go to the grocery store, and while the bill is, we just had our first $300 bill at Safeway. First time ever. I don't know what happened. It was the same 4 bags of groceries, but it was an silly amount of money. But that's inflation. That's that price. But here's the thing. Food prices mean very little to me or to any of us because it's such a small part of the total amount that we spend. Like if I spend $1,000 a month on food and that goes up, 5%, it's not a huge deal, right? It's a huge deal for some folks, no question, right? It's very difficult for people that are of lower income brackets. But here in the United States, that's not the thing that drives the most expenses. So let's look at this. See that the yellow bar and the green bar at the very end? That's CPI. This is core CPI. So there's a spike occurring right now. It's occurring. So the question is, does this continue? If the Fed is right, this is a temporary phenomenon. If the Fed is wrong, this is the beginning of a problem. We don't know. And we're going to talk in a second about that. Yeah, right. So as long as wages are stuck here, then inflation's a big deal. But if wages kind of go up alongside these things, it's less a big deal. If you're a flower and you have bulls running down on you, that's tough, unless you're a real strong flower. Okay. So these are a bunch of little pieces. I don't think you can read this. Above the line, those are things in the last 10 years that have gotten more expensive. Can you read this? College tuition. So that's really the only thing that's off the charts. And then down here you got childcare, healthcare, vehicle maintenance, food and beverage. So food and beverage is actually minor increases. The other big things. Everything else is going down in price. Housing, personal care, clothing, cell phone service, toys. What do we have here? Phones, accessories, personal computers and equipment, and televisions are way down here.
So what is the top one?
The top one is college tuition, right? This is the last 10 years of increases. So inflation is real. It gets kind of blown out of proportion. And in the last 10 years, it hasn't been as big as sort of expected. The question is what happens next? Okay, and I'm gonna read this. This is a week ago. This is Greenspan. Ooh, we don't really care what he says anymore. He's a has-been, but it's an intelligent statement. It's something you don't really want. I mean, you want to hear this from your Fed governors, but this is what he said. None of the central banks have ever been anywhere near where we find we all are and where we have to move as a consequence of the crisis. But what we do not know And we can guess, but it is a guess, and we shouldn't parade it as some great intellectual insight. We just do not know how this thing is going to work out when we begin to tighten. So central banks have done some just insane things. And there's a huge argument that's in the press. It's between economists that are saying, this is really good, this is really bad. So far it's been really good. So far it seems like everything is going wonderfully. The responses from the markets, everything is as one would expect. But we have to stop. We have to taper, and then eventually we have to tighten. Why do we have to tighten? Why don't we just keep rates down at 0% forever? Because if we have another problem, we have no way to stimulate. We have to increase rates to protect ourselves from the future challenges. Okay? So central banks don't seem to be concerned about inflation. As I said, the Fed says it's a temporary phenomenon. Maybe it is, maybe it's not. We don't know. Ben Bernanke says, not Ben Bernanke, Greenspan says, wait and see. We don't know. European banks, look at this. So in the US, a bank holds reserves at the Fed, and the Fed pays them 0.25%, 0.2%, pays them a little bit of interest. In the EU, if you want to hold reserves, you have to pay to keep your reserves there. So why? Because they want EU banks to lend. They're saying, if you put it here, we're going to charge you. If you put it to work in the economy, that's what we want to see. So they're using that as a method of stimulating, okay? We have so many reserves, it's silly. We have an enormous reserve, and we're trying to do that because we do not want to stimulate that way. Because if we stimulate that way, it's way too much. We have so much fuel. It's gasoline for a hot dog. It's just not, it's no good. We got to go slowly, okay? So the Fed has a huge balance sheet.
The Fed isn't the government?
So the Fed is basically a monstrous hedge fund. And they have four, it is. It is backed by the full faith and credit of the United States government. So they have an enormous amount of leverage, more leverage than we let banks do or anything like that. But they also have an infinite time horizon. And the paper that they can print is based on our tax dollars. So they can, current Congress, they don't really have things together. But theoretically at least, our government can raise taxes and raise revenue whenever they want. We have an enormous asset pool in this country. The Fed has a $4-point-something trillion balance sheet. That is basically, it's Fed, it's bank reserves, there's an enormous volume of assets. It was $800 million before 2008. So between 2008 and today, they have purchased, and what does that mean when the Fed purchases? They print money, and they go into the market and they buy bonds, and they put it in their balance sheet. So it's funny money they're using, but as long as it doesn't get out into the economy, it doesn't create a lot of inflation. That's the theory, right? But what it does is it artificially reduces rates, which gives us the opportunity to create money through our banking system, right? So it's still stimulative, it's still very positive, but the Fed does not want the banks to start lending out crazy amounts of money because we already have stimulus. If they do that, then you'll see rates have to go up very quickly. Okay. So given all the stimulus, all the money that's been put out there, and everything that's going on, one would hope that GDP would be going up. And we have an incredible GDP print this morning. We have a 4% GDP print. We had one more like that 2013. We had a 4.1. But we haven't had that in this whole period since 2008. And the estimates are going down. The economists and the World Bank, the IMF, they're saying the growth is not going to be what we expect it to be. They're assuming, they start out at the beginning of the year, and then every year they taper it back. They reduce their estimates. So this is it. This is quantitative easing explained. And this is where, I got ahead of myself, nervous. This is where I should read the Greenspan thing. Is they basically threw a whole bunch of money, and now they're crossing their fingers and hoping. Because we don't know how it's going to result. It may be perfect. Because remember, debt as a percentage of GDP has two different pieces. There's debt and there's GDP. If they stimulate GDP and GDP goes up, then if debt stays level, then sooner or later you get back to a 60 or 70% debt to GDP, which is totally reasonable. We have a huge economy, so we can make these kinds of moves. But maybe it won't work. Maybe we've borrowed from our future purchasing. Maybe we won't see the stimulus. Maybe we won't see the actions come to fruition. Maybe when we do tick rates back up, which we have to do eventually, maybe that will send us off into another recession. So this is the question that we're actually dealing with. Okay. Second thing we're looking at is geopolitical tension. This is not, we've seen this before. Okay, let's go here. This is ISIS. This is not something that causes a massive economic problem. This is an ongoing conflict, but it can cause a short-term problem. This can cause a media frenzy, panic kind of a thing, which we would resolve in 6 months, we would come back. This one is a bigger deal. So I was in Greece when Malaysian Air, okay, so we saw that, and then the next day, and I don't know if anyone else saw this because I've only seen this article once. I've only seen it in one place. I saw that, and so it could be totally BS because I read a lot of blogs. Okay, so and without some sort of major news source saying something about this, I sort of don't believe it. But tell me if you heard this. So I heard that Putin and Cuba were talking about. You did hear this, okay? Yeah. So they're bringing. Yeah, Russia having a larger presence in Cuba with radar, with intelligence infrastructure. So this is no joke. This is Cold War stuff, right? So that's a serious problem in my mind. They're not the power they once were. There's all kinds of, but it's definitely something to maintain awareness of and keep watching. At the same time, there's this enormous amount of corporate cash. So does anyone remember the 4 things that can be done with corporate cash? Or should I just list them off? I'll just list them off in the interest of time. So you can return it to shareholders through increased dividends. You can do mergers and acquisitions. You can buy back stock. You can invest in plant, equipment, and people. Okay, we already saw the CFOs saying they're going to invest more this year in plant, equipment, and people, right? Mergers and acquisitions, we're on a very good pace. So they're spending money in mergers and acquisitions. They're buying back stock like it's going out of style. I mean, it's insane amount, record levels of stock buybacks, okay? And it doesn't seem to be affecting the cash hoard very much. You always hear about so much cash, so much cash, so much cash. See this yellow line right here? So this increase in cash here is cost cutting. That's recession in the gray. This is cost cutting. But right about here and going forward, see the yellow line's pretty stable. See that? It's volatile, but it's 40%, 44%. Over here. That is cash as a percentage of debt. Cash as a percentage of debt. So there's a lot of cash. But if there's a lot of cash and cash as a percentage of debt is pretty stable, what else does there have to be a lot of? Debt. So what we're seeing is companies borrowing to fill their cash stores and taking the borrowed money and buying back stock and doing mergers and acquisitions. So the level of debt is actually high as well. So it's not just we have all this cash. The cash is married with debt. Okay, so we've got to keep that in mind. There's still a lot of cash. They still are investing. They're still doing this. They're building rainy day funds. They don't want to go through 2008 because no one had the cash at the time. Everyone panicked. Like we had, what is this? $700 billion in cash rather than $1.4 trillion in cash. So they want to make sure they have it in case they have to weather a storm. And they're anticipating this storm. They're still anticipating a storm. Okay. The last thing is elections. I don't want to get into a political thing. I don't think this election matters much. I think it's...
When you say this election, which one are you talking about?
The congressional election.
The congressional election.
Right. So let's pretend for a second that the Republicans do take the Senate, and they have the House and the Senate. They're not going to have enough people in there to override a presidential veto, right? And there's a line item veto. So it's not going to make a big difference now. It'll make a big difference in 2 years when there's a presidential election. And if they have the House and the Senate and the president, then it's a different thing. And I'm not opposed or currently for either. I don't want any party to have everything. I don't care which party it is. And then with that, I want to just remind everybody that we need to work together.
smarter to travel in groups.
Thank you very much for coming. I apologize for technology issues.